Ever wonder how those big banks rake it in? Especially when interest rates are all over the place.
Yeah,
Well, that's what we're going to deep dive into today.
absolutely.
Looking at what 2025 could have in store for the banking industry. And our main source for this is a
Right.
financial blog called Mrs. James C. Vi.
Okay.
And it paints a pretty optimistic picture for banks,
Yeah.
even with some of the, recent market hiccups we've been seeing.
Yeah, it's interesting, because after a bit of a roller coaster the last couple of years, things seem to be like lining up
Right.
for a potential recovery. I mean, across the board, loans, trading, the whole shebang.
The source specifically mentions this thing called a
Yeah.
steep yield curve that could really boost bank profits.
Right.
Now, to me, that just sounds like
Yeah.
financial jargon. Can you break that down into something?
Of
Yeah.
course. A steep yield curve basically means there's a big difference between short-term and long-term interest rates. So think of it this way. Banks are kind of like financial middlemen, right?
Right.
They take in deposits from you and me. That's them borrowing money at the short-term rate.
Okay.
And then they lend that money out for mortgages and business loans
Mm-hmm.
at the long-term rate.
Mm-hmm.
So the bigger the gap between those two rates, the more profit they're making.
So if the yield curve gets steeper, my savings account might make a little more,
Exactly.
but that loan I want for that new car is going to be more expensive.
You got it.
It's all connected.
It's all connected.
Now, this blog post also points to the Federal Reserve.
Yeah.
And they've been signaling that they're going to keep interest rates higher for longer,
Right. Higher for longer.
which has caused a bit of uncertainty in the market,
Yeah.
but it could actually benefit banks.
Well, yeah. I mean, because if they're keeping them higher for longer,
Right.
that gap's going to be bigger for longer.
Right.
So the banks are going to benefit more.
The source also walked us through kind of a recent history of how the banking industry has been doing. Didn't 2022 see?
Yeah, 2022 was a great year for a lot of banks.
Yeah, a big surge for certain banks,
Especially those that were,
especially ones focused on trading.
yeah, trading focus. Think like Citigroup, HSBC.
Right.
They were doing really well. There was a huge post-pandemic trade rebound.
Right.
And then you had all this global stuff happening too.
Yeah.
You had the Russia-Ukraine war. You had the Fed, raising interest rates.
Mhm.
And that just made the markets more volatile. And so there was a lot of demand for hedging.
Now, remind me what hedging is again?
Hedging, it's basically a way for investors
Okay.
to protect themselves from potential losses
Okay.
when the market's volatile.
Right.
So let's say you're worried about oil prices going up.
Okay.
You could use a hedging strategy to lock in a price today.
Okay.
So even if the price skyrockets later, you're protected.
Gotcha.
And so banks, they play a big role in providing those financial instruments. And their fixed income currencies and commodities desks, those were really busy.
What's that, FICC?
Yeah, FICC.
Yeah, FICC.
Fixed income currencies and commodities.
Okay.
It's a mouthful.
It sounds like 2023 was a little bit of a turning point, though.
Yeah, it was.
Right.
So banks started seeing wider interest rate spreads, but investment banking activity wasn't quite as robust.
That's okay. So wider spreads, I assume that means that banks...
Wider spreads means they're making more profit on the difference between what they pay on deposits
Yeah.
and what they earn on loans.
Okay.
But there was still a lot of economic uncertainty,
Yeah.
and that made businesses kind of hesitant to invest or take on new projects.
Makes sense.
And so that slowed down a lot of the big investment banking deals.
So where does that leave us as we head into 2025?
Yeah, good question.
The source seems pretty optimistic about it being
Yeah.
a year of recovery for banks.
Yeah.
What's driving that?
So there's a few key factors. One, we're expecting interest rate policies to kind of stabilize a little bit. That removes a lot of uncertainty.
So business can kind of take a breath and
Yeah.
start planning long term.
Exactly.
Okay.
The second factor, fixed income products are becoming more attractive
Okay.
as interest rates stabilize at a higher level.
Mm-hmm.
Those investments are offering better yields,
Right.
which is drawing in investors.
That higher yields means bigger returns.
Exactly.
So
yeah.
more interest.
Pun intended.
Pun intended.
Exactly.
Does the source mention any other factors?
They do. They do. They highlight some potential activity in the energy markets,
Okay.
which makes sense with, the global push for renewable energy and,
Right.
the massive investments that are needed to make that transition.
Of course. We can't forget about traditional energy sources either.
Right. You're right.
Yeah.
Volatility in oil and gas prices.
Yeah.
which is often driven by geopolitics,
Yeah, of course.
creates all kinds of opportunities for banks to help their clients
Gotcha.
manage risks, facilitate trades, all that stuff.
So we've got stabilizing interest rates.
Yeah.
We've got the allure of these fixed income products
Right.
and the potential of energy markets.
Yeah.
What else is on the horizon?
So the source also mentions the gradual release of what they call pent-up corporate financing needs.
Okay.
Basically, all that uncertainty in 2023 made businesses hesitant to
Yeah.
take on big projects.
Right.
But as things start to settle down, we
Mm-hmm.
could see a surge in companies looking for funding,
All right.
for expansion and acquisitions, all those growth initiatives.
So it's like a coiled spring,
Precisely, a
Yeah.
coiled spring ready to release.
and all that financing activity is going to be great for banks.
Exactly.
Okay, so we've covered a lot of ground,
Yeah.
but I'm still curious about this steep yield curve.
Yeah.
We talked about how it can boost profits for banks,
Mm-hmm.
but can you give me like a real-world example?
Sure. Let's imagine a
Yeah.
bank takes in $100 million in deposits from customers,
Yeah.
like you and me,
Right.
and let's say they're paying us 2% interest. Okay.
On those deposits. That's their cost of buying the money.
Okay.
Now, they lend out that $100 million for mortgages
Gotcha.
at, let's say, 6% interest. That's their selling price.
Okay.
The difference between those rates, in
Mhm.
this case 4%,
Yeah.
is their profit margin.
Okay.
It's also called net interest margin, or NIM.
Gotcha.
The steeper the yield curve, the wider that margin gets,
Okay.
and the more profitable those loans become for the banks.
So it's all about leveraging those differences in the interest rates.
Exactly.
Okay.
To make a profit.
Okay.
And as the source suggests, a steep yield curve
Right.
could be a defining feature of the banking landscape in 2025.
This is starting to make sense now. But I'm curious about something else.
Yeah.
The source mentions that banks aren't just relying on that traditional interest income anymore.
Right.
What else are they doing to boost their bottom line?
They're getting creative.
Yeah.
They're branching out into areas like wealth management.
And advisory services, offering a wider range of financial products to their clients.
Makes sense to diversify,
It does.
not put all your eggs in one basket.
Yeah, exactly.
The source even mentions a potential boom in advisory services. Something about private equity firms
Yeah.
needing to exit their investments.
That's an interesting point. So Bain and Company,
Okay.
which is a pretty well-known consulting firm, predicts that almost half of all private equity funds
Wow.
are going to be feeling the pressure to exit their investments by the end of 2024.
Okay.
This could create a huge surge in demand for financial advice
Yeah.
in 2025, as these firms scramble to figure out the best way to sell off their assets.
So banks can cash in on this
They can.
by offering their expertise.
Exactly. They can position themselves as trusted advisors,
Right.
going beyond just lending money
Yeah.
and really helping their clients strategize.
It sounds like there's a lot of potential for growth in the banking industry,
There is.
but I imagine there are some risks and challenges on the horizon as well.
Well-
What are some of the potential downsides that banks might face?
Well, one of the biggest concerns is the possibility of unexpected economic shocks,
Like what?
like a sudden spike in inflation,
Okay.
a major geopolitical crisis that throws global markets into turmoil,
Uh-huh.
or even, dare I say it, another unforeseen pandemic.
Those are some pretty big what-ifs.
Yeah, big what ifs. And they're largely outside the control of banks.
Of course.
And these kinds of events can really,
Right.
impact profitability
Yeah.
and stability.
So how do banks prepare for those kind of curveballs?
Well, it comes down to having robust risk management strategies,
Right.
maintaining strong capital reserves,
Right.
which is basically a financial cushion to absorb losses,
Gotcha.
and sticking to prudent lending practices.
Oh.
Making sure they're not overextending themselves
Right.
or taking on too much risk.
So it's a balancing act.
It is. It's a delicate balancing act.
Trying to grow, generate profits,
Right.
but also being prepared
Yeah, for
Okay.
whatever comes their way.
for anything.
Exactly. And beyond those kind of external shocks,
Yeah.
there are also internal challenges
Yeah.
that banks need to address.
Like what?
One that's getting a lot of attention is the increasing competition from non-bank financial institutions.
Oh, yeah.
These fintech companies.
Fintech,
Yep.
that's a whole other
A whole other deep depth.
deep dive waiting to happen. But
Yeah.
can you give us like a quick overview?
Sure. Fintech companies are often much more agile and innovative.
Right.
They can really leverage technology to offer financial services in a way that's
Oh.
more user-friendly and efficient.
Yeah.
Think about all those mobile banking apps you use.
Right.
Peer-to-peer payment platforms or even online lending platforms.
Yeah, I use those all the time. They're so convenient.
They are, and that's the point.
Right.
That convenience is a big draw for consumers,
Right.
especially younger generations
We
who
said
are
this.
digital natives.
Yeah.
So traditional banks are starting to realize
Yeah.
that they need to keep up with this pace of innovation,
Right.
or they risk being left behind.
That's like adapt or die.
It is. And it's not just about the technology either.
Right.
It's about adapting to changing consumer expectations.
Right.
People want more personalized services,
Yeah.
more transparency, more control over their own money.
Makes sense.
Yeah.
So we've talked about those external shocks.
Yeah.
Competition from fintech.
Uh-huh.
Are there any other challenges out there?
One that's gaining a lot of momentum is the focus on environmental,
Right.
social, and governance factors.
ESG.
Yeah, ESG.
Another one of those buzzwords we hear everywhere.
It is. It's everywhere. But essentially, banks are facing this pressure
No.
from investors, regulators, and the public to consider the broader impact of their decisions.
Right.
Not just the financial bottom line.
So making money responsibly.
Exactly. They're being asked to think about the environmental impact
Okay.
of the projects they finance,
Uh-huh.
their role in promoting social equity and inclusion,
Yeah.
and the ethical implications of their business practices.
That seems like a pretty big shift in
Focus.
mindset for an industry that's historically been focused on profit.
It is a significant shift,
Yeah.
and it's happening really quickly.
So
Many banks are now incorporating ESG factors into their risk assessments,
Right.
their investment strategies, and even their executive compensation plans.
it sounds like they're taking it seriously.
Many are, but it's important to be cautious. There's still a lot of debate about how to actually measure
Yeah.
and standardize ESG performance.
Mhm.
And there's also concern that some banks might be engaging in greenwashing,
Yeah.
making superficial changes to seem more sustainable
Right.
without truly changing their practices.
So not just talking the talk, but actually walking the walk.
Exactly. While the trend toward ESG is encouraging,
Right.
it's important to look beyond the marketing
Right.
and make sure they're making meaningful changes.
This has been a fascinating look at the potential ups and downs
Yeah.
for the banking industry. But we haven't really talked about how all of this might impact like the average person
Yeah.
trying to manage their own finances.
You're right. We've been focused on the big picture,
Yeah.
but it's crucial to remember that what happens in the world of banking,
Right.
affects all of us.
It has a ripple effect.
It does. It does.
So let's bring this all home.
All right.
We've explored these forces at play in the banking industry.
Uh-huh.
But how does this actually translate
Good question.
to our wallets and our financial decisions?
Well, for starters, let's revisit those interest rates.
Okay.
If we're entering an era of stabilized but higher rates, as our source suggests,
Right.
that has a direct impact on your savings accounts and any loans you might have.
Okay, so break that down for me. Higher interest rates,
Mhm.
good or bad for the average person?
It's a bit of both, actually.
Okay.
On the one hand,
Huh.
higher interest rates mean your savings accounts could earn a little bit more.
Okay. I like the sound of that.
That's the upside.
Every little bit helps.
Right. But here's the flip side. Borrowing money, whether it's for a mortgage,
Yeah.
a car loan, or even just carrying a balance on your credit card, becomes more expensive when
Yeah.
interest rates are higher.
Ah, there's the catch.
Yeah.
So it sounds like it's a good time to prioritize saving
Yeah.
and maybe think twice about taking on new debt.
That's a smart approach.
Hmm.
And this really underscores the importance of having a solid financial plan, no matter what's happening in the broader market.
Right.
Creating a budget, managing your debt wisely,
Right.
saving consistently.
Yep.
Those are always going to be essential
Right.
for your financial well-being.
Solid advice. But let's circle back to that steep yield curve for a second.
Okay.
We talked about how it can be a profit booster for banks,
Right.
but how does that translate into opportunities
Good question.
for individual investors?
So remember how a steep yield curve means a wider gap between short-term
I know.
and long-term interest rates? Well, that can create some interesting options if you're looking to invest.
Okay. I'm intrigued. Tell me more.
One strategy could be to look at fixed income investments
Okay.
with different maturity dates.
Okay.
You could put some money into short-term bonds or certificates of deposit
Uh,
CDs
yeah,
that are offering those relatively higher yields right now,
right.
but also consider longer-term bonds that could benefit from rising rates down the road.
So it's kind of like a two-pronged
E-
approach.
Exactly.
Short-term for immediate gains,
Uh-huh.
long-term to ride that interest rate wave.
Exactly. Diversifying your fixed income portfolio
Got it.
across different maturities can
Good.
be a strategic way to capitalize on that steep yield curve environment.
This all makes sense in theory,
Yeah.
but I think a lot of people, myself included, would still benefit from
Oh, absolutely.
professional advice when
Absolutely.
it comes to making big investment decisions.
And speaking of professional advice, remember that potential boom in advisory services we talked about earlier?
Yeah.
If you're at a point where you're facing major financial decisions,
Right?
like selling a business planning for retirement
Uh-huh.
or managing a large inheritance,
Right.
this could be a really good time to seek out
Yeah.
expert guidance.
Especially with all those private equity firms potentially looking
Yeah.
to exit their investments.
Right. There might be more competition among financial advisors,
Yeah.
which could mean better deals for the rest of us.
Exactly.
So it's worth shopping around,
Right.
finding an advisor who really understands your needs and your goals.
Okay, one last thing before we wrap up.
Okay.
We briefly touched on the potential impact of deregulation
Uh-huh.
on the banking industry.
Right.
What should we be paying attention to on that front?
Yeah. It's hard to say for certain what policies might change,
Yeah.
but it's definitely something to keep an eye on.
Okay.
Any shifts in those regulations could have big implications for
Wow.
consumer protection, lending practices, and even the stability of the whole financial system.
So staying informed is key.
It is. Staying informed and understanding those potential consequences
Yeah.
is really important.
So it all comes back to being informed and engaged,
It does.
staying on top of these trends
Yeah.
so we can make the best financial decisions for ourselves.
Absolutely. The more you understand how the financial world works,
Right.
the more empowered you'll be to navigate it successfully.
Well said. Thanks for diving deep with us today.
It's been a pleasure.
We hope you found this exploration of the banking industry
Yeah.
insightful and maybe even a little bit inspiring.
It's been fun.
Until next time, stay curious and keep those wallets happy.
Sounds good. Yeah, it's about making money responsibly. They're being asked to think about the environmental impact of the projects they're financing and their role in promoting social equity and inclusion and, just the ethical implications of their business practices in general.
That seems like a pretty big shift for an industry that, has historically been focused on just the bottom line.
It is. It's a big shift, and it's happening really fast. I mean, many banks are now incorporating ESG factors into their risk assessments, their investment strategies, and even, their executive compensation plans.
Well, it sounds like they're taking it seriously.
Many are, but, it's important to be cautious. There's still a lot of debate about how to measure and standardize ESG performance.
Right.
And there's always that concern about greenwashing,
Right.
making superficial changes just to kind of seem more sustainable.
Right. Just to look good.
Exactly, without actually, changing their practices.
So not just talking the talk,
Right.
but walking the walk.
Exactly. While the trend towards ESG is encouraging,
Right.
it's important to look beyond the marketing
Yeah.
and make sure they're actually making real changes.
This has been a fascinating look at the potential ups and downs
Yeah.
facing the banking industry.
Absolutely.
But we haven't really talked about how all of this might impact like the average person
Yeah.
trying to manage their own finances.
You're right. We've been focused on the big picture,
Yeah.
but it's important to remember that what happens in banking affects us all.
It has a ripple effect.
It does. It does.
Right. It does. So let's bring this all home. We've explored these forces at play in the banking industry, but how does this actually translate to our wallets and our financial decisions?
Well, for starters, let's go back to those interest rates.
Mhm.
If we are entering an era of stabilized but higher rates, like our source suggests, that has a direct impact on your savings accounts and any loans you might have.
Okay. So break that down for me. Higher interest rates. Good or bad for the average person?
It's kind of both, actually. On the one hand, higher interest rates mean your savings accounts could earn a bit more.
Okay. I like the sound of that. Every little bit helps.
That's the upside. But here's the other side. Borrowing money, whether it's for a mortgage, a car loan, or even just carrying a balance on your credit card, it's going to be more expensive when interest rates are higher.
There's the catch. So it sounds like it's a good time to prioritize saving and maybe think twice about taking on more debt.
That's a smart approach, and it really highlights the importance of having a solid financial plan. No matter what the market's doing, creating a budget, managing your debt wisely, and saving consistently, those are always going to be important for your financial well-being.
Solid advice. But let's go back to that steep yield curve for a second. We talked about how it can boost profits for the banks, but how does that translate into opportunities for individual investors?
Well, remember how a steep yield curve means there's a wider gap between short-term and long-term interest rates?
Yeah.
Well, that can create some interesting options if you're looking to invest.
Okay, I'm intrigued. Tell me more.
One strategy could be to look at fixed income investments with different maturity dates.
Okay.
So you could put some money into short-term bonds or certificates of deposit CDs that are offering those higher yields right now, but also think about those longer-term bonds that could benefit from rising interest rates later on.
So kind of like a two-pronged approach. Short term for those immediate gains and long term to ride that potential interest rate wave.
Exactly. Diversifying your fixed income portfolio across different maturities can be a really strategic way to take advantage of that steep yield curve.
This makes sense in theory, but I think a lot of people, myself included, would still benefit from professional advice when it comes to making those big investment decisions,
Oh, absolutely.
especially with all those private equity firms maybe looking to exit their investments.
Right.
It sounds like there's going to be more competition among financial advisors.
Yeah, which could mean better deals for us regular folks. It's definitely worth shopping around, finding an advisor who gets your needs and your goals.
Okay, one last thing before we wrap up.
Okay.
We talked a bit about the potential impact of deregulation on the banking industry. What should we be watching for? And how could it affect our everyday financial lives?
It's tough to say exactly what policies might change, but it's definitely something to keep an eye on. Any changes in those regulations could really impact consumer protection lending practices and even the stability of the whole financial system.
So staying informed is key.
It really is. Staying informed and understanding what could happen. That's really important.
So it all comes back to being informed and engaged.
Exactly.
Staying on top of these trends so we can make the best financial decisions for ourselves.
The more you understand how the financial world works, the better you'll be at navigating it.
Well said. Thanks for diving deep with us today. We hope you found this exploration of the banking industry insightful and maybe even a little bit inspiring.
It's been a pleasure.
Until next time, stay curious and keep those wallets happy.